There are 5 big things that you need to know when I talk about taking over somebody's loan. There's 2 different ways to do it, either subject to the existing loan or the assumption. Let's talk about the 5 differences. So both subject to transactions and assumptions involve acquiring a property using the existing financing. They do operate a little bit different. They both carry distinct responsibilities and have varied implications for both buyers and sellers. So here's a breakdown of the differences for the top 5. First, we're going to talk about transfer of liability. In a subject to transaction, the buyer takes title to the property, but the mortgage remains in the seller's name. And while the buyer agrees to make payments on the loan, the legal obligation to pay the loan actually stays with the seller. Essentially, the property is acquired subject to the existing financing. And conversely, in an assumption, the buyer not only takes title to the property, but also takes on the legal responsibility to pay off the loan. The buyer is now legally obligated to pay the mortgage, and the original borrower is released from all liability to pay off that note. The mortgage is fully transferred to the buyer's name. The number 2 item is the due on sale clause. First off, with the subject to transaction, most mortgages have what's called a due on sale clause. And what it says is that in the event the property is sold, retitled, then that mortgage can be called due. So the bank can say, hey, you just sold that property. I want my money. You have 30 days to pay it. That is in the contract. That is in the loan paperwork that the buyer signed when they first bought the home. So the lender has the right to invoke that clause, but they don't have the obligation to invoke the clause. Matter of fact, it's rarely done in the case of a subject to. And some people will bring this up frequently and say, hey, this is a thing that we really need to worry about. In reality, ask them to provide you a name of somebody that has had the due on sale clause called on them. They probably can't do it. So think about it from the bank's point of view. If they have a property that is being used as collateral for a loan and the loan is being paid and suddenly the title on that property changes, but the loan keeps getting paid, they are okay with that. Because if they suddenly call that note due, there's a good chance that suddenly they're going to miss a payment. Well, not miss a payment, that they're not going to pay it. And now they have to go through foreclosure proceedings and they possibly face money, and it costs them time and money. So most commonly, the banks will not enforce the due on sale clause as long as payments are being made. Conversely, in an assumption, not only is title moved over to the buyer, but also the entire financing obligation is moved over. In a formal loan assumption, the lender is involved in the process, they approve the buyer, and so they never invoke the due on sale clause because they actually approve the buyer to take over that loan. Some older loans may be assumable without lender approval. I have never seen one of those. Most conventional loans are not assumable. All government loans are assumable. Number 3 is the qualification process. In a subject to deal, generally there is no qualification process since there is no lender. The agreement is between the buyer and the seller. Conversely, with an assumption, the buyer will have to qualify to take over the loan with that lender. And that's a long process, involve credit checks, proof of funds, sourcing of funds, tax returns, all sorts of things, just like a normal loan application. The number 4 difference between subject to and assumption is release of liability. In a subject to, the seller remains liable for the loan. If the buyer stops making payments on the loan, it can create problems for the original seller, even though they no longer own the property. Conversely, with an assumption, once the loan is assumed, the seller no longer has any liability whatsoever. They've been completely released of liability. All liability to pay off that loan remains with the new buyer. The number 5 difference between subject to and an assumption is formal documentation. Documentation and formality with a subject to deal, it's essentially an agreement between the buyer and the seller. You take it to an attorney to make sure that all of the title work is done properly and you have the right documents to start making payments on the loan, and that's about it. It's a very fast process. On the other hand, for an assumption is an incredibly drawn out process. 3, 4, 5, 6 months are not unheard of when it comes to assumption. There's the entire approval process for the new buyer, as well as all of the legal work. It is an incredibly formal process, and there's a lot of back and forth, and it is very time consuming for not only the buyer, but also the seller. Now, both methods have their pros and cons. The big takeaway is that it depends on the situation of the seller and the buyer as to what's the best deal for them. For the vast majority of people, A subject to deal does not apply. It is not something that works for them. There are people where it is a great option. On the other hand, an assumption is not always the best answer either. Many times a buyer may say an assumption is a great idea and the seller says, no, I don't like that. It is essential that if you're thinking about a sub-2 or an assumption, that you consult with a professional, not only real estate agents, but also an attorney who can talk you through the process. Specifically, you want to talk with people who have done both deals before. We've done subject to deals. We've also done assumptions. We can talk to you about the experience and tell you who they are good for, who they're not good for, and the level of difficulty of each, and what some better options might be depending on your particular scenario.